Ever dreamt of owning a piece of the pie in the real estate market, but felt discouraged by the hefty down payment requirements? This guide equips you with creative strategies to get started in real estate investing without breaking the bank. 1. Real Estate Investment Trust. REIT companies own or finance income-generating properties, like apartments, offices, or retail centers. They offer everyday investors a chance to benefit from this real estate without the hassle of buying, managing, or financing a property themselves. Here's how it works. Invest in REIT stocks. You can buy shares in a specific REIT company, giving you a piece of their real estate portfolio. REIT ETFs and mutual funds. These options allow you to invest in a basket of multiple REITs, spreading your investment and reducing risk. As a REIT shareholder, you'll typically receive regular dividend payments, a portion of the income generated by the properties the REIT owns. This provides a steady stream of income without the responsibilities of direct property ownership. Remember to hit subscribe for weekly wealth creation tips. 2. VA loan. VA loans offer a fantastic benefit. You can finance 100% of an income-producing property. The property must be your primary residence. This means opting for a multi-unit property where you'll live in one unit and rent out the others for additional income. Not a fan of managing tenants? You can rent out up to 25% of the property's square footage as a commercial space, like a small office or storefront, while still living on site. This way, you can leverage the VA loan advantage and potentially generate rental income from your own home. 3. Home equity loan. Soaring property values can be your key to unlocking real estate investment opportunities, even without a big initial investment. Here's why. Home equity as your investment ally. When your home value increases, you build equity, the difference between your home's current market value and what you still owe on your mortgage. 2 ways to leverage your equity. If you have significant equity, you have options. Cash out refinance. This involves replacing your existing mortgage with a new, larger loan. Say you have a $100,000 mortgage and $200,000 in equity. With a cash-out refinance for $160,000, assuming an 80% loan-to-value limit, you can pay off your current loan and have $60,000 left for a down payment on an investment property. Home equity loan or line of credit. Here, you keep your original mortgage but borrow against your home's equity. Shop around to find lenders who allow you to use these funds for investment purposes. Remember, tapping into home equity involves taking on additional debt. Make sure you have a solid financial plan and can comfortably afford the repayments before moving forward. 4. Seller financing. Seller financing sounds like a shortcut to homeownership, especially if traditional mortgages seem out of reach. But hold on. While it can be tempting to skip the bank and negotiate directly with the seller, there are hidden risks you need to be aware of. In seller financing, the seller essentially becomes your lender. They hold the loan and you make payments directly to them. This can be faster and sometimes more flexible than the traditional route, but it comes with both financial and legal risks for you and the seller. These agreements also have different names, like land contracts or contracts for deed. Before you get swept up in the excitement of a potential deal, make sure you understand the pros and cons thoroughly. 5. Hard money loan. Need financing for a real estate deal, but traditional lenders say no? Hard money loans might be an option, but be prepared for a different kind of loan. Hard money loans, sometimes called bridge loans or asset-based loans, are short-term financing solutions, specifically for real estate. Unlike traditional mortgages from banks or credit unions, hard money loans come from private lenders or individual investors. Hard money loans offer quick access to cash for your real estate project, but they typically come with higher interest rates and shorter repayment terms compared to traditional mortgages. 6. Option to purchase agreement. Renting, but dreaming of owning? A rent-to-own agreement could be your key. This contract gives you, the tenant, the exclusive right to buy the property you're currently renting at a future date. Here's the exciting part. A portion of your monthly rent goes towards the down payment, building your equity over time. Essentially, you're renting with a path to ownership. But before you get too excited, there are some things to consider. Rent to own can be risky. These agreements often come with higher monthly payments than traditional rentals, and you might be responsible for some maintenance costs as well. No guaranteed sale. Even if you fulfill your end of the deal, the landlord can still back out of the sale. Here's how to protect yourself. Get your own lawyer to review the contract thoroughly. This ensures you understand all the terms and potential downsides. Compare the rent-to-own option against traditional mortgages to see which one makes more financial sense for you in the long run. Rent-to-own can be a great stepping stone to homeownership, but it's not for everyone. Make sure you understand the risks and benefits before signing anything. 7. Private money loan. Dreaming of real estate investing, but short on cash? Private money loans can be an option to get you started quickly. These loans come from private lenders, not banks, and can be a good choice if you need financing fast. The downside? Interest rates on private money loans tend to be significantly higher than traditional mortgages. It's a good option for short-term financing, similar to a hard money loan. If you need more time to repay, the high interest can quickly eat into your profits. Is there a way around the high cost? Absolutely. Consider borrowing from friends or family. They might be willing to offer you a lower interest rate, especially if they believe in your investment goals. Just remember, clearly outline the loan terms in a written agreement to avoid any misunderstandings down the line. 8. Wholesaling. Imagine making money in real estate without ever owning a property. That's the allure of wholesaling. Here's how it works. Finding deals. Wholesalers seek out undervalued properties, often distressed ones they can buy below market value. They negotiate a purchase agreement with the seller, locking in a good price. The wholesaler then finds an investor willing to pay a higher price for the contract. The investor finalizes the purchase with the original seller, and the wholesaler pockets the difference. Wholesaling requires hustle, negotiation skills, and a deep understanding of the market to find good deals and convince both sellers and investors. I hope this video helps you in being one step closer to your financial goals. Please give a thumbs up on the video if you have enjoyed watching. If you have any questions, please leave them in the comments below. And be sure to subscribe to our channel for more wealth creation tips. Bye.